Hello everyone. Today we will finish the last part of financial statement, that is the cash flow statement. The cash flow statement is a very important financial statement as it reveals how much cash the company is actually generating. Activities of a company. Before we go ahead to understand the cash flow statement, it is important to understand the activities of a company. If you think about a company and the various business activities it undertakes, you will realize that the company's activities can be classified under one of the three standard baskets. We will understand this in terms of an example. Imagine a business, maybe a very well established fitness center with a sound corporate structure. What are the typical business activities you think a fitness center would have? Let me go ahead and list a few business activities. Display advertisement to attract new customers. Hire fitness instructors to help clients in their fitness workout. Buy new fitness equipments to replace worn out equipments. Seek short term loans from bankers. Issue a certificate of deposit for raising funds. Issue new share to a few unknown friends to raise fresh capital for expansion, also called preferential allotment. Invest in a startup company working towards innovative fitness regimes. Park excess money in fixed deposits. Invest in a building coming up in the neighborhood for opening a new fitness center sometime in the future. Upgrade the sound system for a better workout experience. As you can see, the listed business activities are quite diverse. However, they are all related to the business. We can classify these activities as operational activities. Activities that are directly related to the daily core business operations are called operational activities. Typical operating activities include sales, marketing, manufacturing, technology upgrade, resource hiring, etc. Investing activities. Activities pertaining to investment that the company makes with an intention of reaping benefits at a later stage. Examples include parking money in interest bearing instruments, investing in equity shares, investing in land, property, plant and equipment, intangibles, and other non current assets, etc. Financing activities. Activities pertaining to all financial transactions of the company, such as distributing dividends, paying interest to service debt, raising fresh debt, issuing corporate bonds, etc. All activities a legitimate company performs can be classified under one of the above three mentioned categories. Keeping these three activities in perspective, we will now classify each of the previously mentioned activities into one of the three categories. Display advertisement to attract new customers. It is expenditure towards advertisement. It comes under operational activities. Cash balance decreases, treated as an asset as it increases brand value. Hire fitness instructors to help customers with their fitness workout. It is expenditure towards new recruits. It comes under operational activities. Cash balance decreases, treated as an asset as it increases the company's intellectual capital. Buy new fitness equipments to replace worn out equipments. It is expenditure towards new equipment. It comes under operational activities. Cash balance decreases, treated as an asset. Seek short term loans from bankers. Loan means cash flow to business. It comes under financial activities. Cash balance increases. Loan is a liability. Issue a certificate of deposit for raising funds. Deposits via CD means cash inflow. It comes under financial activities. Cash balance increases. CD is a liability. Issue new shares to a few known friends to raise fresh capital for expansion. Issue of fresh capital means cash inflow. It comes under financial activities. Cash balance increases, treated as liability as share capital increases. Invest in a startup company working towards innovative fitness regimes. Investment in startup means cash outflow. It comes under investing activities. Cash balance decreases. Investment is an asset. Park excess money in a fixed deposit. Money parked in a FD means cash going out of business. It comes under investing activities. Cash balance decreases, equivalent to cash, hence considered as an asset. Invest in a building coming up in neighborhood for opening a new fitness center sometime in the future. Investment in building means cash going out of business comes under investing activities. Cash flow decreases. Gross block considered an asset. Upgrade the sound system for better workout experience. Expenditure towards the sound system, it comes under operational activities. Cash flow decreases, treated as an asset. If you look through the table and start correlating the cash balance and asset liability, you will observe that whenever the liabilities of the company increases, the cash balance also increases. This means if the liabilities decreases, the cash balance also decreases. Whenever the asset of the company increases, the cash balance decreases. This means if the asset decreases, the cash balance increases. The above conclusion is the key concept while constructing a cash flow statement. Also, extending this further, you will realize that each activity of the company, be it operating activity, financing activity, or investing activity, either produces cash or reduces the cash for the company. Hence, the total cash flow for the company will be cash flow of the company is equal to net cash flow from operating activities plus net cash flow from investing activities plus net cash flow from financing activities. The cash flow statement. Having some insight into the cash flow statement, you would now appreciate the fact that you need to look into the cash flow statement to review the company from a cash perspective. Typically, when companies present their cash flow statement, they split the statement into three segments to explicitly show how much cash the company has generated across three business activities. Continuing with our example from the earlier chapters, here is the cash flow statement of Amar Raja Batteries Limited. I will skip going through each line item as most of them are self-explanatory. However, I want you to notice that ARBL has generated 278.7 crores from operating activities. Note a company which has a positive cash flow from operating activities is always a sign of financial well-being. Here is a snapshot of ARBL's cash flow from investing activities. As you can see, ARBL has consumed 344.8 crores in its investing activities. This is quite interesting as investing activities tend to consume cash. Also remember, healthy investing activities tells the investor that company is serious about its business expansion. Of course, how much is considered healthy and how much is not is something we will understand as we proceed through this module. Finally, here is a snapshot of ARBL's cash balance from financing activities. ARBL consumed 53.1 crores through the financing activities. If you notice, the bulk of the money went in paying dividends. Also, if ARBL takes on new debt in future, it would lead to an increase in the cash balance. Remember, increase in liabilities increases cash balance. We know from the balance sheet that ARBL did not undertake any new debts. Let us summarize the cash flow from all activities. This means the company consumed a total cash of Rs 119.19 crores for the financial year 2013 to 2014. Fair enough. But what about the cash from the previous year? As we can see, the company generated 179.98 crores through all its activities from previous year. Here is an extract from ARBL's cash flow statement. It says the opening balance for the year is 409.46 crores. Well, this happens to be the closing balance for the previous year. Add to this the current year's cash equivalents 119.19 crores along with a minor forex exchange difference that is of 2.58 crores. we get the total cash position of the company, which is 292.86 crore. This means while the company guzzled cash on a yearly basis, they still have adequate cash thanks to the carry forward from the previous year. Note, the closing balance of 2013-14 will now be the opening balances for the 2014-15. Clearly, we can now infer that the cash flow statement and the balance sheet interact with each other. This is in line with what we had discussed earlier. That is, all the three financial statements are interconnected with each other. A brief on the financial statements. Over the last few videos, we have discussed the three important financial statements of the company, that is, the P&L statement, the balance sheet, and the cash flow statement of the company. While the cash flow and P&L statement are prepared on a standalone basis, the balance sheet is prepared on a flow basis. The P&L statement discusses how much the company earned as revenues versus how much the company expended in terms of expenses. The retained earnings of the company, also called the surplus of the company, are carried forward to the balance sheet. The P&L also incorporates the depreciation number. The depreciation mentioned in the P&L statement is carried forward to the balance sheet. The balance sheet details the company's assets and liabilities. On the liabilities side of the balance sheet, the company represents the shareholders' fund. The assets should always be equal to the liabilities. Only then do we say the balance sheet has balance. One of the key details on the balance sheet is the cash and cash equivalents of the firm. This number tells us how much money the company has in its bank account. This number comes from the cash flow statement. The cash flow statement provides information to the users of the financial statements about the entity's ability to generate cash, and cash equivalents as well indicates the cash needs of a company. The statement of cash flows are prepared on a historical basis, providing information about the cash and cash equivalents, classifying cash flows into the operating, financing, and investing activities. The final number of the cash flow tells us how much money the company has in its bank account. We have so far looked into how to read financial statements and what to expect out of each one of them. We have not yet ventured into how to analyze these numbers. One of the ways to analyze the financial number is by calculating a few important financial ratios. In fact, we will focus on the financial ratios in the next few videos. Thank you for watching this video. Please do like, comment, and share this video to your friends and family members. Also, don't forget to subscribe my channel.